Whether you file taxes yourself or pay someone to do it for you, understanding your tax return and where the numbers come from can be valuable knowledge. My name is Mike Heatwall, and I'm the founder and CEO of the Dollar Group, a wealth management firm focused on helping retirees. In this video, I will take you through each line of your 1040 tax return and show you what tax mistakes and tax planning opportunities we look for when we complete our annual reviews for the families we work with. So let's dive in. Here are the 7 sections we will cover. Section 1, information about you. Section 2, income you made. Section 3, deductions you can take. Section 4, taxes you owe. Section 5, credits applied to your bill. Section 6, payments you have made. And Section 7, refund due or balance owed. First, we have the information about you section. This is where you tell Uncle Sam who you are, where you live, your filing status, and details about your dependents. It's straightforward. Just fill in your basic details such as name, address, and social security number. Now, getting your social security number right is crucial because it ties all your income and tax information together. When choosing your filing status, options include single, married filing jointly, and head of household. This choice affects your deductions, your tax rates, and your credit eligibility, so make sure you select the correct one. If you're unsure which filing status to select, we recommend reading the IRS Form 1040 instructions. You can find those easily by searching Form 1040 instructions in your preferred web browser. The instructions provide detailed descriptions of each option to help you select the appropriate one. Now, once you finish your filing option selection, you're going to check whether the boxes in the standard deduction area apply to you, especially if you're a retiree or legally blind. This can significantly increase the amount you can deduct from your income. Lastly, list your dependents. Typically, these are children or elderly parents that you support financially and who are living with you. The rules about who qualifies as a dependent can be complicated, so we recommend reading those same instructions if your situation may be different from other families. Now, one item that can complicate this section is divorce. Depending on your divorce agreement, you may not be able to claim your dependent children every year. A second item we see is forgetting to claim your elderly parent as a dependent when you are taking care of them and when you're providing financial support. Section 2 is the income you made section. Line 1A covers earned income from W-2 forms subject to Social Security and Medicare tax, also known as FICA taxes. The interesting thing about line 1A is that it may not match your actual pay. This can often be confusing for individuals. Line 1A is calculated by taking your gross pay and subtracting any pre-tax benefits paid through payroll, such as medical, dental, and vision premiums, HSA contributions, and pre-tax 401k contributions. This is why line 1A can often be significantly less than your gross income. Now, line 2A is where you will report tax-exempt interest, which typically means you have invested in municipal bonds and therefore no federal tax is owed on the interest payments from those bonds. Line 2B is where you will report taxable interest earned throughout the year, typically from checking, savings, CDs, money market funds, and bonds that are not tax-free municipal bonds. Now, when we see a significant dollar amount on line 2B, we immediately ask, do we have too much money in interest-bearing accounts, and would it be more beneficial to shift that money into other investments or into accounts that are more tax efficient? For instance, if a client has both a taxable investment account and an IRA, could we shift some of the investments that are paying taxable interest into the IRA so we don't have to pay tax on the interest every year? And we can use different investments in the taxable account that are more tax efficient, such as individual stocks, index funds, or ETFs. Now, line 3A is where you will report qualified dividends that are taxed at a preferential rate versus ordinary dividends, which will be reported on line 3B. Qualified dividends are taxed at a lower preferential rate, whereas ordinary dividends are taxed at your normal income tax rate. So, what is a qualified dividend? A qualified dividend is a dividend you received from an investment that meets a set of rules the IRS provides in Publication 550. Now, the rules are complicated and beyond the scope of our video. So for our purposes, let's assume that if you hold an individual company stock, which is domiciled in the US, any dividends paid to you will be taxed as qualified dividends. The major exception to this rule is if you own real estate investment trusts, or REITs for short, as those are treated as ordinary dividends. So, if I hold Home Depot stock and it pays me $5,000 a year in dividends, and I'm in the 24% income tax bracket, my $5,000 of qualified dividends will only be taxed at 15%, versus my income tax bracket of 24%. This would result in tax savings of $450 on these dividends. So you can see that as the dividend amounts become larger, the spread between what I owe for qualified dividends versus ordinary dividends matters. Now, one confusing item about how these dividends are reported is that line 3B includes the qualified dividends from line 3A. So if my total dividends are $10,000 and $7,000 of that amount are qualified dividends, I would report $7,000 on line 3A and $10,000 on line 3B. Like the interest reported, we look at the dividends to see if there's a more tax-efficient way to position the investments. If possible, investments that pay ordinary dividends or taxable interest are moved to a retirement account, whereas investments that pay qualified dividends should be held in a taxable account to take advantage of the preferential tax treatment. Line 4A is where you will report your gross IRA distributions. This information is reported to you by the investment institution on Tax Form 1099-R. This form is typically received in February. Line 4B is where you report the taxable amount of your IRA distributions. We typically see errors made on lines 4A and 4B when one of the following three strategies is implemented. Number 1, rollover, in which the check was made out to the client instead of the institution. Number 2, qualified charitable distributions. And number 3, backdoor Roth IRA contributions. So let's discuss each of these items in more detail. For item number 1, it is best to transfer an IRA directly from one institution to another, with the transfer happening electronically or the check made out to the receiving institution. For instance, if I'm transferring my IRA from Fidelity to Schwab, I would complete a Fidelity transfer form to have my investments transferred directly to Schwab. Now, if Fidelity does not allow an electronic transfer, I would want the check made out to Charles Schwab, not to me individually. By doing this, Form 1099-R will not show a taxable distribution. If instead I have them make the check out to me and then I deliver it to Schwab, the 1099-R form will show the distribution as taxable even though it is not if I deposit the check within 60 days. If you find yourself in this situation, you will include the distribution on line 4A but not on line 4B. You can write rollover next to the amount on line 4B. The second item on our list that may cause an issue in reporting is a qualified charitable distribution. A qualified charitable distribution is a distribution from your IRA that is given directly to a charity. In this case, the distribution will be included on line 4A but not on 4B, as it will not be treated as a taxable distribution. Remember that financial institutions do not track the amount you give to charity, so the 1099-R form will show the full distribution amount as a taxable withdrawal. It is up to you to tell the IRS what amount of that withdrawal went to charity throughout the year. You do this by subtracting the amount given to charity on line 4B. Now, we created a separate video focused on qualified charitable distributions, which I will link in the description below. The third item on our list is backdoor Roth IRA contributions. This strategy is typically used when a household is over the income limits to make a direct Roth IRA contribution. When this occurs, we may implement a strategy known as a backdoor Roth IRA contribution, in which we make a non-deductible IRA contribution first, and then immediately convert that contribution to your Roth IRA. Assuming there are no other IRA funds in the individual's name, the Roth IRA conversion should not be taxable because the initial IRA contribution was not deductible in the first place, so taxes are already being paid on that amount. The Roth IRA conversion is often reported incorrectly on line 4B as a taxable amount resulting in double taxation of these funds. Instead, these backdoor Roth IRA contributions must be reported on Form 8606, which will ensure that the Roth conversion is not treated as a taxable event. So in summary, many of the strategies we use in retirement, such as backdoor Roth IRA contributions, Roth conversions, and qualified charitable distributions, are reported on lines 4A and 4B, and we monitor the reporting closely. So let's move on to line 5. Line 5A is where we report 401k, 403b, and pension distributions and rollovers. We also include annuity withdrawals on these lines. We don't tend to see errors on these lines other than if the rollover is reported incorrectly. For any direct rollover in which the check is made out to the receiving institution, the rollover amount will be listed on line 5A and not on line 5B, as it is not a taxable distribution. Line 6A is where you will report your gross Social Security benefits as a household. You must use the Social Security benefits worksheet in the Form 1040 instructions to determine how much of your Social Security benefits are taxable. The taxable amount will be reported on line 6B. We created a video specifically on how your Social Security benefits are taxed, which is linked in the description below. Now, line 7 is where you will report your capital gains or losses. There are 3 main reasons you would have capital gains or losses to report. Reason 1, you sold investments in a non-retirement account. Reason 2, you hold mutual funds or other investments in a non-retirement account that pass through their capital gains to you even when you haven't sold anything. And reason 3, you sold property or a business during the year. There are a couple of important items to address here. Gains and losses from investments will offset each other. The net gain or loss from all the sales is then reported on line 7. If your net losses are more than $3,000, you are limited to $3,000, and the rest of your loss will be carried forward into the following year. So let's consider a quick example to understand this concept. If I sell mutual fund A for a gain of $10,000, and I sell mutual fund B for a loss of $15,000, I will have a net $5,000 loss to report. Since I am limited to $3,000 in losses, I will write negative $3,000 on line 7 and will carry forward $2,000 in losses to the next year. The $3,000 loss will directly lower my taxable income for this year, and assuming I do not sell any additional investments next year, I will then be able to write negative $2,000 on line 7 in the next year to use my remaining losses. The most common error on line 7 is not reporting the capital gains and losses. If you have a non-retirement investment account such as a TOD, joint account, brokerage, or trust account, ensure you provide your 1099 form from the financial institution to your tax preparer. If you're using tax software, we found that the import function does not always work, so compare the numbers imported to your 1099 form. Now, line 8 is where income from Schedule 1 is reported. The most common income items we experience on line 8 are income from a business, rental properties, or unemployment. In the case of a business or rental property, we always check to ensure the expenses associated with this income are reported. For instance, if an individual has a side business from home, we expect to see costs for internet, phone, home office, etc. New business owners often underreport their expenses because they don't realize some of the items that can be included. Now, for rental properties, we're looking to ensure the depreciation is being reported, along with the other associated expenses. Section 3 is the deductions you can take. We're going to skip lines 9 and 10, as there aren't a lot of planning opportunities found there. So line 11 is your adjusted gross income. The IRS uses AGI to determine certain caps, such as who is allowed to make Roth IRA contributions. Line 12 is important when it comes to tax planning opportunities. The Tax Cuts and Jobs Act of 2017 doubled the standard deduction, so most filers are now using the standard deduction. The deduction on line 12 is subtracted from line 11 to determine how much taxable income you have. The larger the deduction, the better. The 2024 standard deduction amounts are provided for you here. For married filing jointly, the standard deduction is $29,200. For single filers, $14,600. For each individual 65 or older, an additional $1,550 is provided. And there is also an additional deduction of $1,950 for head of household filers. The main tax planning opportunity on line 12 occurs when households can itemize their deductions. This occurs when the itemized deductions add up to more than the standard deduction. The most common reason for a household to itemize their deductions is when they give significant money to charity. So here are the 5 main questions we ask when looking at charitable giving. Question 1, does it make sense to donate appreciated assets this year? Question 2, can we help provide more efficient giving through other tools? Question 3, would a donor-advised fund make sense for this household? Question 4, is the client eligible for a qualified charitable distribution? And question 5, Would charitable gift bundling make sense for this client? For more details on charitable giving strategies, there are additional links in the description below. Finally, you may have a qualified business income or QBI deduction on line 13. So you'll subtract your deductions from your AGI to get your taxable income on line 15. Now section 4 is taxes you owe. This is the amount due based on your taxable income. We have a graduated tax system, meaning different portions of your income are taxed at different rates. Your tax software or accountant will handle these calculations, ensuring accuracy. A link is provided in the description below explaining how your federal tax is calculated. Section 5. Credits applied to your bill. Credits can significantly reduce your tax bill. Unlike deductions, which lower your taxable income, credits reduce the tax you owe dollar for dollar. The child tax credit on line 19 is well known, giving parents $2,000 for each child under 17. There are other credits on Schedule 3 which can also help reduce your tax bill. These include energy-efficient home improvements, clean vehicle purchases, and foreign tax credits. So if we subtract your total credits from the amount owed on line 18, you'll find your new total tax amount on line 22. Now section 6 is the payments you've made. Let's discuss payments you've made. This section shows the taxes already paid through withholding or estimated payments. Line 25A includes amounts withheld from your W-2s. And if you're self-employed, you'll report estimated tax payments on line 26. If you total all the payments and enter the sum on line 33. Now section 7 is the refund due or balance owed. Finally, the moment of truth. How close were you to paying the right amount? If you overpaid, you get a refund on line 34. While getting a big refund feels good, it means you've been giving the government an interest-free loan. If you've underpaid your taxes, the amount you owe is on line 37. Consider having a tax withholding analysis done to keep more money in your pocket throughout the year or to eliminate surprise tax bills. As a side note, we do this for our clients at no additional cost. If your financial professional does not offer this service, you will need to pay your tax preparer to complete a tax withholding analysis to determine the changes you need to make on your W-4 or to your estimated tax payments. If you found this information helpful, please give us a thumbs up and subscribe for more financial insights. Thanks for watching, and we'll see you next time.